All right, let's talk about something most of us would rather not think about, but it's a topic that's quietly affecting more and more families right here in the UK. I'm talking about inheritance tax. We're going to explore how something as old as gold can actually be a really smart, modern tool for protecting your legacy. And to make sure we get this right, we're using the fantastic insights from the experts at Pro Tax Accountant who helped put this whole breakdown together. So, let me ask you something, straight up. Could 40% of everything you've worked your entire life for, your home, your savings, your business, just disappear when you try to pass it on? It's a shocking thought, but for a growing number of people, it's a very real possibility. Yeah, 40%. Let that sink in for a second. It's not just some random number. It's the standard rate of inheritance tax here in the UK for anything over a certain threshold. It's a figure that can completely change the legacy you leave behind. And that's exactly why being proactive about this is so crucial. So, how do we get our heads around this? Well, over the next few minutes, we're going to pull apart the inheritance tax trap, look at the surprising tax benefits of gold, get to grips with the 7-year gifting rule, and flag some really common and costly mistakes. We'll also bust that old myth about hidden wealth, and then wrap it all up with a clear plan of action for you. Okay, let's dive right in. The 40% inheritance tax trap. You might think this is a tax just for the mega rich, but that's not the case anymore. With house prices going through the roof, while the tax-free limits have stayed frozen, ordinary families are being pulled into the net. It's becoming a real wake-up call for so many people. So what is inheritance tax, really? Well, in simple terms, it's a tax on your estate. That's all your stuff when you pass away. Now, every single person in the UK gets a £325,000 tax-free allowance. It's called the nil rate band. But anything over that amount could be taxed at that 40% rate. The critical piece of the puzzle, that $325,000 limit, has been frozen solid since 2009, and it's staying that way until 2028. Your assets have grown, but the tax-free limit has just stood still. And this is where it really hits home. Let's take a small business owner in London. Their home alone is worth, say, £550,000. Well, that's already way over the £325,000 tax-free limit. Suddenly, there's a taxable chunk of £225,000. And at 40%, you're looking at a potential tax bill of £90,000, just on the family home. But look, it's definitely not all doom and gloom. A bit of smart planning can be a complete game changer. And that brings us to an asset you might not have considered, gold. It turns out it has some pretty powerful and, you could say, hidden advantages when it comes to planning your estate. Right, but listen, not all gold is the same in the eyes of HMRC. This is so important. As you can see here, big gold bars are exempt from VAT, which is great, but you'll still pay capital gains tax if they increase in value. Jewelry, that often gets hit with both, but look at that middle row. This is the game changer. UK legal tender coins like sovereigns or Britannias, they are exempt from VAT and exempt from capital gains tax. That is a huge difference. This is the ultimate advantage, really, because these coins are officially UK currency. Any profit you make when you sell them is completely tax-free. They can grow in value for years and years, and you'll never have to worry about a capital gains tax bill on that growth. For anyone thinking long-term about protecting their wealth, this is a massive win. And hey, here's a little bit of trivia for you, just to show how quirky these rules can be. Did you know that medals and military decorations awarded for valor are completely exempt from inheritance tax? It's HMRC's way of saying that some things have a value that you just can't put a price on. Okay, so what else can you do? Well, you could argue that the single most effective way to reduce an inheritance tax bill is to simply give your assets away during your lifetime. The strategy is simple, but, and this is a big but, you have to do it the right way. And that all comes down to what's known as the 7-year rule. This has a fancy name. It's called a potentially exempt transfer, or a PET for short. Basically, when you give something like cash or those gold coins to another person, it's considered a PET. And the key word here is potentially. If you live for a full 7 years after making that gift, it becomes 100% exempt and falls completely outside of your estate for tax purposes. But what if you don't make it the full 7 years? That's a fair question. And that's where something called taper relief kicks in. If you pass away within the first 3 years, the tax is the full 40%. But after year 3, as you can see, the tax rate starts to slide down, reducing every year until after 7 years, it hits 0. It's a sliding scale that can still lead to some pretty big tax savings.
And don't forget, there are also things you can do every single year that are immediately tax-free. You can give away £3,000 each tax year. You can also give as many small gifts of £250 to as many different people as you want. And there's another powerful one people often miss: making regular gifts out of your normal surplus income. Those can be immediately exempt too.
Okay, so you know the good stuff, but knowing the rules is only half the battle. Now we need to talk about the pitfalls, the common mistakes that can completely undo all your careful planning. And stay with me, because this first one might surprise you. This is hands down one of the biggest and most expensive mistakes people make. You see, for probate, HMRC wants the open market value, what something would realistically sell for today. This is completely different from an insurance value, which is what it would cost to replace it brand new. Using the wrong one can mean you overpay by thousands. It's like the difference between a new car's showroom price and what you'd actually get for it a year later. And here's another classic blunder: reservation of benefit. Imagine you give some gold coins to your son, but you keep them in your safe at home for him. Well, because you still technically have control over them, HMRC will say it wasn't a real gift at all. For a gift to count, you have to completely let go of it. That 7-year clock we talked about, it doesn't even start ticking until you've truly let go. So here's a pro tip, and it's a really simple one. Always, always create a deed of gift. It's just a simple document signed with a witness that puts it in writing that the gift has been made, it's final, and you can't take it back. If HMRC ever comes asking questions years down the line, this document is your best piece of evidence. All right, now for the ugly part, and we need to be really serious here. It's this myth of hidden wealth. There's this dangerous idea that you can just stash away physical things like gold and they'll be off-grid or invisible. In the world we live in today, that could not be further from the truth. You see, HMRC has this incredibly powerful computer system called Connect. It's not some person in a basement. It's a machine that sifts through billions of bits of data on all of us: bank records, property sales, online selling platforms, even social media, and it connects all the dots to spot anything that doesn't add up. And believe me, that net is only getting tighter. As of January 2025, online platforms have to automatically report seller information directly to HMRC. If you sell more than 30 items or just over £1,700 worth of stuff in a year, all your details go straight to the tax man. The bottom line? Selling that kind of stuff online isn't a private transaction anymore. Far from it. And if you get this wrong, the consequences can be, well, pretty severe. A genuine mistake might land you a penalty of up to 30% of the tax you owe. But if HMRC decides you deliberately tried to hide something, the penalty can be as high as 100% of the tax due, on top of having to pay the tax itself. Hoping they won't notice? That's not a strategy, it's a gamble. Okay, wow, we have covered a lot of ground, haven't we? From the traps and the rules to the serious pitfalls. So now, let's pull all that information together into a clear, simple action plan that you can use to protect your legacy and give yourself some peace of mind. So let's boil it all down to a simple 3-step action plan. Number 1, choose your assets wisely. Focus on those capital gains tax-free UK legal tender coins. Number 2, document everything. Use a proper deed of gift to make your intentions crystal clear. And number 3, get expert valuations. Always use the open market value for probate, not the insurance value. Now, it is so important that I say this. Everything we've talked about today is for general guidance only. Tax law is complicated, and everyone's personal situation is unique. So please, do not rely on this information alone to make any big financial decisions. So if you want to take real control of your legacy, the best thing you can do is get advice that's tailored just for you. The specialists at Pro Tax Accountant are there to help with exactly that. You can give them a call or drop them a WhatsApp on 07985 689912, or you can send an email to info@protaxaccountant.co.uk. We'll leave you with this one last thought. Your legacy is the result of a lifetime of hard work. It doesn't just happen by accident. It has to be protected. The real question is, are you doing everything you can to protect yours?